Use of these new technologies has proven to spur innovation that aids in the delivery of services and products to consumers and small businesses. These advancements come at a time when bank lending to borrowers with less than pristine credit, small businesses and startups seems to have stalled. According to a recent study by Deloitte, marketplace lenders, for instance, accounted for loan originations worth almost $40 billion over the last decade. Today, many online lenders have the technology to offer consumer and small business loans with better terms and conditions. An increasing role for fintech also shows the financial needs of Americans have changed. The rise of online banking and mobile payments technologies have revolutionized the way Americans interact with institutions and make financial decisions. While we should always advocate for innovation that helps the American people and the economy, we must also understand the implications this type of technical revolution can have on consumers and financial institutions. So my colleagues on the subcommittee have raised questions over both potential positives and negatives these types of lenders may have on underserved borrowers and communities. These are conversations that need to take place so we can have a holistic view of this diverse and growing marketplace. It's also important to spend time understanding the regulatory regime surrounding fintech. Predominantly regulated by the states, questions have recently been raised as to whether or not federal laws that apply to similar products and companies should apply to fintech. At the federal level, the previous comptroller of the currency championed an optional federal charter for fintech companies, an idea that's been debated in Congress for a number of years. The Trump Treasury Department has also opined on ways in which to support safe online lending platforms. This subcommittee will continue to deliberate measures surrounding fintech that will promote freer and fair lending to more American families and businesses. Some of the bills, including a bill introduced by the gentleman from Indiana, Mr. Hollingsworth, will provide certainty in the marketplace and encourage community banks to partner with fintech companies to better serve their customers. As we examine these complex issues, we must be careful not to unnecessarily stifle access to capital. We should aim to foster a better understanding of the many facets of fintech and create an environment that fosters responsible innovation without jeopardizing consumer protections or creating an uneven playing field. The bottom line is that this is a universe that seems to evolve on a nearly daily basis. It's my intention to hold a number of hearings on fintech. I'm confident today's conversation will be a great start, and I will again thank our witnesses for their time. The chair now recognizes the gentleman from Missouri, Mr. Clay, a ranking member of the subcommittee, for 5 minutes for an opening statement.
Thank you, Mr. Chairman, and I will not take the entire 5 minutes, but I appreciate you holding this hearing to examine opportunities and challenges in the fintech marketplace. Thank you to each of the witnesses for shedding light on this subject. In June of 2016, the Obama administration held a White House FinTech Summit to engage with stakeholders about the potential for fintech. Then in January 2017, the administration compiled its takeaways into a statement of principles as a policy framework for the fintech ecosystem. The 10 principles encourage stakeholders to, one, think broadly about the financial ecosystem, start with the consumer in mind, promote safe financial inclusion and financial health, recognize and overcome potential technological bias, maximize transparency, strive for interoperability and harmonize technical standards, build in cybersecurity, data security, and privacy protections from the start, increase efficiency and effectiveness in financial infrastructure, protect financial stability, and continue and strengthen cross-sector engagement. The Trump administration on fintech, under the Trump administration, the Treasury Department has indicated plans of releasing a paper on non-bank financial institutions, financial technology, and financial innovation as part of their comprehensive financial regulatory review pursuant to Executive Order 13772 from President Trump. It is unclear when Treasury's fintech paper may be released, so this is a timely and important hearing. Thank you all again to each of today's witnesses, and I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss, the vice chair of the subcommittee, for 2 minutes to deliver an opening statement. Mr. Rothfuss.
Thank you, Mr. Chairman. I want to thank you and the Ranking Member Clay for calling today's hearing on the fintech marketplace. This is an important topic, and it demands the attention of policymakers. Just as the growth of fintech presents us with regulatory questions and the challenge of dealing with disruptive technological change, it also represents a tremendous opportunity to make more and better financial products available to an even greater number of consumers. As we look at communities that have lost their local bank or underserved areas trying to get back on their feet, fintech can be a solution. New online lending programs, mobile banking, and other developments can help bring capital back into places that brick-and-mortar institutions abandoned a long time ago. I should mention that fintech is also an issue in which I have a parochial interest. Western Pennsylvania has become a fintech hub, drawing on the region's high-quality workforce and premier educational institutions. Major Western Pennsylvania financial institutions like PNC and BNY Mellon have ventured into the fintech space, setting up dedicated facilities to cultivate new ideas. The region is also home to promising incubators like Steel Bridge, as well as independent entrepreneurs who work tirelessly to bring new fintech products to market. I had the privilege of meeting with many of Western Pennsylvania's fintech leaders and learning about the opportunities and challenges they face. I hope that our work on this committee will help to allow for continued innovation while providing sufficient supervision and consumer protection. I look forward to hearing from today's witnesses how we can take our first steps on this important issue. With that, Mr. Chairman, I yield back.
Gentleman yields back. With that, let's introduce the panel today. We welcome the testimony of Mr. Daniel Hoops, Executive Director, Marketplace Lending Association, Mr. Brian Knight, Director of the Program on Financial Regulation and Senior Research Fellow at the Mercatus Center, George Mason University, Mr. Brian Peters, Executive Director, Financial Innovation Now, Mr. Andrew Smith, Partner, Covington and Burlington, Professor Adam Levinton, Professor of Law, Georgetown University Law Center. We recognize that each of you will be recognized for 5 minutes to give your oral presentation or testimony. Without objection, each of your written statements will be part of the record. As a tutorial on the lights, some of you may not have been here before. Green means go. At the 1 minute mark, the yellow light will come on. Hopefully, we can wrap it up at that point. Red means stop, and hopefully, we can wrap it up very quickly. With that, Mr. Hoops, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Ranking Member Clay, members of the committee, for the opportunity to testify here today. I'd also like to thank the staff for their hard work. The Marketplace Lending Association, formed in 2016, has grown to 20 member companies. The criteria for membership are that platforms meet a standard of safety responsibility toward consumers and to the marketplace. MLA members must be transparent with consumers about APR, annualized rates, any penalties or fees in the loans, and not offer any so-called payday or high-cost installment loans defined in numerous places, including the Military Lending Act, as loans above 36% APR. In small business lending, MLA member platforms adhere to the Responsible Business Lending Coalition, a group of both for-profit and nonprofit entities that came together to create the Borrower's Bill of Rights, or to an equivalent standard. Mr. Chairman, Ranking Member Clay, this industry is effectively serving the broad American middle class, one that remains the engine for economic growth and prosperity today. It is also creating opportunities for investors that previously were reserved only for the wealthiest borrowers, wealthiest in America. MLA members can save borrowers as much as $20,000 in student loan refinancing. They can save members thousands of dollars in refinancing high-cost credit card debt. They can reach the broad, underserved population in America. They can help those underserved populations secure a better financial future for themselves, for their families, and for small businesses. Today, I'd like to talk about opportunities for this committee, and indeed for Congress generally, to take action to support legislation and new chartering opportunities for financial technology firms that can broadly advance the interests of America's middle class. So what are marketplace loans? The fintech data tracking firm DV01 advises that more than 1 million marketplace loans were issued last year. The average loan balance, $14,000. The average APR, 14.7%. These are far from the short-term, high-rate products that many associated with the earliest days of online lending. These are also well-regulated loans. These are loans that are overseen by the FDIC, loans overseen by state consumer protection regulation, and loans that are offered in a transparent way to consumers across America. Today, there's more than $1.023 trillion in outstanding credit card debt. That's an enormous debt that borrowers have an opportunity to refinance with marketplace lenders at lower rates. Small business owners report they are very pleased with having new online options. 95% report they would consider taking another loan with another online lender. So imagine the possibilities if we could update the regulatory framework, one that we use today designed for a 19th and 20th century banking system that didn't envision the internet, to one where startups, small businesses, and innovators can better serve consumers, businesses, students. To do that, encourage Congress to move the Protecting Consumers' Access to Credit Act, a bill sponsored by members of this committee that passed earlier in November. I'd also support the committee to look at Irs Data Modernization Act. That one bill would enable a small business lender to verify a borrower's income in real time rather than waiting weeks, a time that often in today's economy they don't have, and to serve a small business owner with a better product because they have a better picture of that person's true financial profile. Finally, I think this committee should support options for fintech firms to apply for charters. The Special Purpose National Bank Charter at the OCC and the FDIC ILC charter are both under development. I appreciate the time, and I thank the committee.
Gentleman's time has expired. With that, we recognize Mr. Knight for 5 minutes.
Thank you, Chairman Lukemeyer, Ranking Member Clay, and the members and staff of the subcommittee. I'm honored to testify today. Whether it's a mortgage to buy a first home, the ability to quickly and cheaply send money to a loved one, or accessing credit when in need, financial services are vital to the American dream. Advances provided by financial technology, or fintech, have the potential to provide Americans with better, cheaper, and more inclusive financial services. Unlocking that potential requires modernizing the regulatory environment to encourage innovation and competition while providing Americans with necessary consumer protection. Because while financial technology may be able to help people, there is a risk that misregulation will inhibit this possibility. So Congress should modernize regulation to foster innovation, competition, and inclusion. Financial services are seeing a series of potentially significant changes, including the removal of geographic limitations thanks to the internet and mobile devices, the use of new algorithms and machine learning, the entrance of firms from outside traditional finance, including both startups and well-established companies like Amazon, and the rapid adoption of new services by customers. Peer-to-peer and mobile payments are now practical, as well as daily payments for workers, removing the need to wait for payday. There are also innovations like cryptocurrencies, which some believe could entirely remake the financial system, along with the capital markets, real estate, and other industries. While not a panacea, these innovations show real promise. For example, there's evidence that innovative lenders can offer borrowers credit at better rates or extend credit to borrowers who would otherwise have trouble accessing it. Evidence also indicates that innovative lenders are replacing banks in communities where banks have been forced to leave because it is no longer profitable for them to serve, and that algorithmic underwriting may lead to less discrimination than traditional underwriting. However, there is also risk. While technology enables legitimate businesses to reach new customers without regard for distance, it also allows fraudsters to find new victims. While cryptocurrencies allow the oppressed to avoid the predations of their government, it can allow those same governments to avoid sanctions. Done well, initial coin offerings might make our capital markets more efficient. Done poorly, they leave both investors and well-meaning but ignorant companies exposed. While there are risks, we must remember two things. First, there is no regulatory vacuum. Regulators currently have and are using the power to prohibit and punish violations of the law. Fintech lenders that partner with banks are subject to regulation by the bank's regulators and the CFPB. And the CFPB, SEC, FTC, and CFTC have all brought enforcement actions in fintech-related areas and will continue to do so. Second, we must remember that traditional finance also presents risk. As such, fintech innovation should not be judged against perfection, but against the status quo. While some regulation is necessary to protect Americans, the current regulatory environment unduly impedes positive innovation in several ways. In the interest of time, I will limit my discussion to three. First, many non-bank fintech firms are subject to burdensome state-by-state regulation in areas where banks offering comparable products enjoy broad uniformity thanks to federal law. This makes it difficult, if not impossible, for these innovative firms to compete directly with banks. The OCC charter previously mentioned is one possible avenue to address this problem, at least for some firms, but it's unclear whether or not it will move forward and whether or not it will be viable if it does. Even if the OCC charter does move forward, it should not be the only option available. Second, even if firms partner with banks, recent litigation and regulatory actions have called into question the legitimacy of those partnerships. This risks reducing access to those most in need of new options. Third, the United States lacks a scalable way for companies to safely experiment with new technologies. Countries, including the United Kingdom, Australia, and Singapore, have pursued a so-called regulatory sandbox to provide firms a way to try new products with a lower regulatory burden while still protecting consumers. While some regulators at the federal and state level are working to become more welcoming to innovation, the fragmentation of our regulatory system makes it hard to create a program that provides a truly friendly environment for experimentation. Congress can help encourage better financial services for all Americans. It can do this by providing certainty to the bank partnership model, a path to regulatory equity that can include both the OCC and the states, and a mechanism for state and federal regulators to allow innovators to try new ideas while protecting investors. Doing so will help ensure our financial system is competitive, innovative, and inclusive for the future. I look forward to our discussion, and thank you for your time.
Gentleman yields back. Mr. Peters is recognized for 5 minutes. Welcome.
Thank you, Chairman Lukemeyer, Ranking Member Clay, and members of the committee for the opportunity to testify. My name is Brian Peters, and I am the Executive Director of Financial Innovation Now, FIN, an alliance of tech companies working on policies to make financial services more accessible, safe, and affordable. The members of FIN are Amazon, Apple, Google, Intuit, and PayPal. These companies are at the forefront of America's economic growth. They collectively employ over 700,000 people and spend more on R&D, $40 billion annually, than any other companies in the United States. They're innovating many new financial tools, such as digital wallets, secure online payments, personal finance apps, and access to capital for small businesses. Many of these tools work in partnership with traditional financial institutions. We believe that one of the best opportunities of technology is the potential to improve financial inclusion and increase access. 25% of Americans remain unbanked or underbanked, but there's growing evidence that the mobile internet is helping to reduce some of the traditional barriers to financial services. The speed of money also matters. In our era of instant messaging, it does not make sense that it can still take days for a payment to clear. For those on a tight budget, like half of Americans living paycheck to paycheck, this delay could cause undue hardship in the form of high-cost alternative financial services, sometimes costing 10% of income just to access money when it is most needed. Fortunately, the Federal Reserve is shepherding a commendable industry-led effort to achieve faster payments by 2020. FIN is a part of this effort and supports the Fed's leadership because we want real-time payment clearing to be a 24/7 reality as soon as possible. Financial management applications also offer another area of promise. These tools have helped millions of consumers and businesses create budgets, set savings goals, avoid fees, and find better offers. It's like having your own personal accountant. Small businesses also have new options. Fin members already offer a broad set of small business technology tools, including payment processing, payroll, inventory management, sales and data analytics, and shipping logistics, just to name a few, all of which make basic elements of running a business faster and less expensive, both online and on Main Street. We are now expanding this technology toolbox with the addition of capital. And it is our broader integration of these tools that enables small businesses to utilize their own sales and accounting data to qualify for capital quickly and conveniently. Importantly, early research shows that these sources of capital are filling gaps for underserved small businesses. All of these tools mean more competition and broader economic growth. These benefits could be enhanced through policies that keep pace with innovation and meet the needs of today's consumers and commerce. My written testimony contains a number of common sense policy proposals for the committee's consideration. I will briefly mention several. Number one, create an optional national money transmission license. Payment innovators currently are regulated under a fractured regime in nearly every state. An optional national license would offer consistent safeguards, and it would enhance innovation and consumer access to new payment options evenly across the country. Number two, update the Card Act to include oversight of card network rules and their impact on consumer choice and access to payments. Number three, restore the valid when made principle. Fin thanks the committee for passing the Protecting Consumers' Access to Credit Act, introduced by Congressman McHenry and Congressman Meeks. Number four, support the good institutional work of financial regulators to better address technology, such as the OCC's Office of Innovation and the Consumer Financial Protection Bureau's Project Catalyst. Financial Innovation Now thanks the committee for the opportunity to testify, and we look forward to working with you towards a better financial services future. Thank you.
Thank you, Mr. Peters. Mr. Smith and Professor, you guys have got a tough bar to go over here. And I got three guys, and they've hit their time right on the dot here. Mr. Smith, welcome. You're recognized for 5 minutes.
Thank you. Yep, a hard act to follow. Everyone hit it right on the money. Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee, thank you.
Could you please move forward so we can hear you with the microphone?
Thank you for the opportunity to appear before you. My name is Andrew Smith. I'm a partner in the law firm of Covington and Burling and currently serve as the chairman of the Consumer Financial Services Committee of the American Bar Association. I'm appearing this morning on my own behalf to testify about the opportunities and challenges presented by fintech and the need to amend existing laws to ensure the continued ability of banks to partner with fintech firms to deliver new and innovative products and services to consumers. The use of fintech to offer credit products to consumers enhances competition and increases consumer access to high-quality credit offered conveniently over the internet and mobile devices. But the electronic marketing, origination, and servicing of credit products is technically demanding, and many banks, particularly community banks, don't have the technical expertise to provide these products safely and efficiently. Smaller banks also may not have the capital and liquidity needed to achieve the critical mass needed for a national lending program. Fintech firms, for their part, need banks to access the payment system and to establish a national platform to offer products on a 50-state basis. In other words, banks and fintech firms need one another, and the relationship between them can pay big dividends for consumers and for the economy. The FDIC has recognized the importance of permitting banks to partner with fintech firms to offer credit products to consumers and has laid out a robust regime for supervising these relationships, including 12-month examination cycles, concurrent risk management and consumer protection examinations, and direct supervision of the fintech firms themselves. Allowing banks and fintech firms to partner with one another to offer credit to consumers enables consumers to work with a federally supervised lender giving them greater confidence and security and helping to integrate them into the traditional banking system. All of these benefits, however, are being threatened by a new line of court decisions, concluding that even where a bank made the lending decision, funded the loan, and is the legal lender, the bank may not be the so-called true lender if the bank does not have the quote-unquote predominant economic interest in the loan. Many courts have reviewed the loan agreement to determine that the bank is indeed the lender and that there is no basis to upset the agreed-upon relationship between the lender and the borrower. Other courts, however, have taken it upon themselves to look through the loan agreement and the legal rights and obligations of the parties to make a subjective determination that the bank is not the true lender. These courts have held that a third-party service provider or even an investor might be the actual lender. These court decisions have the potential to upset the well-settled commercial expectations of the various participants in the transaction. Because if the bank is not the true lender, then the federal banking laws may not apply, and the underlying loan, or even a whole portfolio of loans, may be considered to be invalid under state lending laws. This type of uncertainty is unacceptable to participants in financial markets, and if these decisions start to take hold, banks may find it impossible to find firms willing to partner with them on acceptable terms, and we would risk losing all of these demonstrated consumer and economic benefits of partnerships between fintechs and banks. Although the law, in my judgment, already is crystal clear that if a bank makes a loan, then the bank is the lender, legislation has been introduced that would reiterate and reconfirm this bedrock principle and would make clear that the existence of a service or an economic relationship between a bank and another person doesn't change the fact that the bank made the loan. This legislation would create greater certainty in commercial relationships and provide the additional clarity and direction to these courts considering true lender challenges. Thank you again for inviting me to testify. I'd be happy to answer any questions.
Thank you, Mr. Smith. Professor, welcome. Recognized for 5 minutes.
Thank you. Mr. Chairman Lukemeyer, Ranking Member Call, members of the subcommittee, good morning. My name is Adam Levitin. I'm a professor of law at Georgetown University. Thank you for inviting me to testify here. I'm testifying solely as an who studies consumer finance. I have no financial interest in any fintech company. I'd like to note that a number of my students from my consumer finance class are here today, and I'm glad that they're having the opportunity to witness the legislative process in action.
Do they get extra credit for that, Professor?
I certainly will take it into consideration.
Okay, thank you.
There are a huge range of non-bank financial services companies that fall under the rubric of fintech. Some offer payment services and some offer credit services. Some compete with banks, some partner with banks. Some fintechs provide services that can really help improve Americans' financial lives, as you've heard from the other witnesses. But other fintechs, particularly in the credit and cryptocurrency areas, engage in predatory and abusive behavior. While it's easy to get caught up in the hype around fintechs, it's important to distinguish among them and take actions to facilitate the good players in the fintech space without also protecting the abusive ones. My written testimony contains several concrete suggestions for the subcommittee to consider, and I'd like to highlight 3 of them. First, I'd urge the subcommittee to consider the creation of a federal money transmitter license. It's a federal felony to transmit money without a license, and the current money transmitter licensing regime is state-based. This might make sense for small money transmitters operating from a storefront or 2, but it makes little sense to require companies like Amazon, Apple, or PayPal that operate national internet-based payments platforms to get 50 different money transmitter licenses. A federal money transmitter license will eliminate duplicative state regimes. I would, however, also urge that any federal money transmitter licensing regime be paired with an insurance requirement to protect consumer funds held by transmitters, such as balances in PayPal accounts. These balances are currently uninsured, and that's concerning. Second, the committee should consider steps to encourage greater consumer financial data portability. Banks are often reluctant to enable the sharing of consumers' data with fintechs, whom they correctly see as potential competitors. But this is precisely why such data portability should be encouraged. Consumer banking relationships are suboptimally sticky. Consumers don't switch financial relationships when they should, and that means consumers end up overpaying for their banking services. Giving consumers greater rights regarding the portability of data for their own transactions have generated would help improve the competitive landscape of consumer financial services. And here I'd like to relatedly endorse a point that Mr. Peters made about amending the CARD Act with regard to card association rules. Third, I strongly urge the subcommittee not to encourage predatory lending through rent-a-bank schemes. Unfortunately, both H.R. 4439, the Modernizing Credit Opportunities Act, and H.R. 3299, the so-called Madden Fix bill, do precisely this. These bills are blank checks for predatory lending. These bills enable banks to launder loans for non-bank lenders by letting the non-bank lenders buy not just the loans from the banks, but also the benefit of federal preemption of state consumer protection laws. It's frankly outrageous that Congress would even consider facilitating such an abuse of the banking system. Federal preemption of state law is part of a package that goes with an extensive system of federal regulation, to which fintechs are not fully subject. Preemption is a personal privilege for banks, and it's really not something they can sell. Yet that's exactly what H.R. 4439 and H.R. 3299 do. These bills put preemption of state laws up for sale. I recognize that H.R. 3299 is presented as a bill to protect so-called marketplace lenders, but it's drafted so broadly that it also shields internet payday lenders and debt buyers. Indeed, both bills would actually enable payday lending in the roughly half of states that prohibit it outright, and they would effectively void the interest rate and rollover limitations that are imposed by the half of states that do allow payday lending but regulate it. In other words, H.R. 3299 and H.R. 4439 are bills that authorize unrestricted payday lending nationally. If Congress wants to do that, it should be upfront about what it's doing, rather than claiming that it's restoring a legal doctrine or reining in errant court decisions. There are a lot of ways that fintechs can improve consumers' lives, and we should encourage them when they do that. But the fintech buzzword should not be a license for permitting risky, abusive, or fraudulent behavior in the financial system. I look forward to your questions.
Thank you, Professor. Would your students please raise your hand? Very good. Well, welcome. And if you need an excuse for the rest of your classes that you're going to skip today, let me know. We can help you out with that. But again, thank all the witnesses for their testimony today. We've got a little housekeeping issue here right quick. Without objection, the gentleman from Illinois, Mr. Holtgren, the gentleman from Indiana, Mr. Hollingsworth, the gentleman from Minnesota, Mr. Emmer, the gentleman from Missouri, Mr. Cleaver, are permitted to participate in today's subcommittee hearing. While not members of this subcommittee, they are all members of the Financial Services Committee. We appreciate their participation today. This is, as you can see, a very, very interesting and very much needed conversation to have, and we got a lot of other members that want to participate today, so we're looking forward to the discussion. Let me recognize myself for 5 minutes and begin the discussion. Mr. Knight, you're recognized as Director of Program on Financial Regulation, so can you give me just a little discussion here with regards to, you know, fintech is an area where we need to be very careful. We want to make sure we don't, we want to continue to allow innovation. We want to make sure we keep a level playing field. So how do you thread the needle on regulating too much, not enough, make sure that people are protected, yet allow the innovation it takes? Can you just describe a little bit what you think would be a scenario under which we can keep the playing field level and allow innovation and still protect consumers?
Thank you, sir. I will try.
It's a big question, I know.
It's a challenging question. I think that the important thing that we need to think about is keeping the consumer always in mind first and foremost. There's nothing sacred about any particular type of financial service. It's all about what serves the customer's need. If something better comes along that displaces payday or banks or marketplace or whatever, and it serves customers' needs better, we should allow that to happen and not shed a tear. So that's the first goalpost, I think. With regards to a level playing field, which is obviously a phrase that gets thrown around a lot, I think we need to regulate to the risk. And so to compare and contrast banks with marketplace lenders, banks fund their loans in part through federally insured deposits. And that federal insurance of the deposit, the fact that they're using deposits that are given to them by customers with the understanding that the customer can demand it back at any time, that the customer is not taking on any risk that their balance will go down, implicates certain rules and regulations and a certain legitimate need for a certain type of consumer protection. Loans that are funded by investors who know they're putting their money up for risk and are not federally insured present different types of consumer protections. In that case, the concern should be around the investor not taking on extra contractual risk. By this I mean, if I invest money in a loan, I understand I'm taking on the risk that the borrower might default. What I'm not taking on is the idea that the lender might fail and sever the connection between me and the borrower. So the borrower, check in hand, willing to pay off his loan, just doesn't know where to send it to, and I'm sitting on the other end, unable to get funding. And so things like backup servicing provisions would be very important in that respect. With regards to in our mindset, I think one thing we need to think about is the idea of enabling and helping regulators get a better understanding of the pace of innovation, because it is ever increasing, and regulators, while well-meaning, often find themselves behind the times a bit. And so that's one of the reasons why I commend that we look at the concept of something like a regulatory sandbox, which, as with everything else in this space, there's some definitional issues, but an environment where regulators can engage with companies in a scalable way. The companies can try new things out with the understanding that they must protect their consumers. If consumers are harmed due to a violation of the law, the company stands ready to make them whole.
If I could interject just 1 second. That's an interesting way to go, and I think we need to be looking at this, because basically what you're saying is we need to allow pilot projects with safe harbors for the entities to be able to develop a product, and if it works, fine. If it doesn't work, they can move on. But there needs to be in place a regulatory regime within which they allow that to happen. Is that basically what you're saying?
Absolutely, with two other caveats. One, this pilot program should not be a place where only favored firms can get in and obtain some sort of major competitive advantage. And there are ways we can mitigate against that risk. Two, the pilot programs should not just be necessarily at the federal level. The states present an excellent venue for this and can serve as the cliche goes, laboratories of democracy. But because of the overlapping and fractured nature of federal regulation in this space, there's going to have to be some clarification, some forbearance instituted to allow that to be viable.
Okay. My time is about up. I will yield my time back. With that, we will go to the other gentleman from Missouri here, Mr. Clay, recognized for 5 minutes. He's the ranking member.
Thank you, Mr. Chairman. Professor Leventon, according to Federal Reserve Board Governor Lael Brainerd, and I quote, "It is often hard for the consumer to know what is actually happening under the hood of the financial app they are accessing. The app's websites and terms and conditions of fintech advisors and data aggregators often do not explain how frequently data aggregators will access a consumer's data or how long they will store that data. If things go wrong, consumers may have limited remedies, and it is not uncommon to see terms and conditions that limit the fintech advisor's liability to the consumer to $100, unquote. Professor Leventon, do you agree with Governor Brainerd's concern, and what can Congress do to address these privacy issues?
So I absolutely agree with Ms. Brainerd's concerns. There are a few steps Congress can take to address these issues. First would be legislation that would restrict the use of binding mandatory arbitration clauses in consumer financial contracts. Unfortunately, Congress voted to overturn very narrowly by one vote, to overturn the CFPB's rulemaking to that effect, but that is something that Congress should revisit. Secondly, besides the arbitration limits, I think Congress should also consider legislation that would restrict stipulated damages clauses in consumer financial contracts. I haven't thought through the details of what that would look like, but that should be something Congress should consider.
Would any other panelists like to address how we protect consumers' data as well as the whole hacking of checking accounts and credit card. Anyone? Mr. Peter.
I'd be happy to address this. First, I think that Governor Brainerd's comments in the financial technology space generally are very thoughtful and very welcome. I think she's brought a deep level of insight to this, especially with respect to consumer protection issues. I represent a number of companies that are obviously innovating in incredible ways. We take the view that many of the apps and the technologies that people have in their pocket enable all kinds of consumer disclosure and better awareness because the technology itself is that much more dynamic. With respect to the issue you alluded to of consumers accessing their financial data, they're doing that because it's their data and because they want to make better sense of their financial lives. They're using technology tools to better manage their finances, to find savings, to better budget. When we think about that dynamic, we work with financial institutions, and I think there's actually been a lot of progress made to help address the needs of the shared customer, to make sure that we have a more technologically sophisticated and efficient way to enable that kind of application to work. I think that there's still a lot more work to be done among industry players to get us to that more efficient connection, and I think we're getting there. But we need more effort.
Yeah, but Mr. Peters, don't you also agree that they are also exchanging data among these different companies so that they can market to these consumers? And it may be a hard sell, and it may not be, but and that don't consumers have? Should they have a say in who can look at their data?
I believe they should have sufficient disclosure, and there should be transparency about how any technology they have is operating, yes.
And then how do we protect those consumers too? I mean, there are also bad actors too that access this data, or it sometimes can access it, and the protections are not foolproof. So what do we do about that?
Well, our companies, in many ways, are security companies first. We didn't start off developing another product and then add security onto it. So we take security very seriously. When it comes to this specific issue, there's a way of doing this called open application interfaces, which are secure in a more efficient way for consumers to establish that connection. I think the challenge we have in financial services is that there are very many financial institutions, thousands, and what we need to do is work towards a standardization to allow all these financial institutions to use that approach. That's a secure way to do it, and I think it would address many of the concerns you have.
I thank you for your response. I went over. I yield back.
Gentlemen, time has expired. With that, we go to the Vice Chair of the committee, Mr. Rothfuss, still in from Pennsylvania, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Knight, if I can ask you a couple questions. It might be helpful to take a look at what some other countries are doing in this space. How does the U.S. compare to other major countries in terms of fintech regulation?
Well, I'll be honest, it's a mixed bag. There are certain countries, the United Kingdom being sort of held up as the general leader, who've taken a very concerted effort to become a leader in the space and have been very innovative in their regulation. Now, some of that, and some of that advantage is just sort of baked in. Unlike the fragmented system the United States has, the UK has, I believe at this point, 3 financial regulators, and the Financial Conduct Authority is their primary consumer protection regulator, and that allows them to house a lot of innovative products in the FCA, like the Sandbox, like Project Innovate, and give sort of a one-stop shop for companies to check off all the regulatory boxes. The UK also doesn't have the federalism that we have. Other countries like Singapore and Australia have followed suit. Again, a more unified situation, and allowing programs like regulatory sandboxes to allow for innovation. On the other hand, I mean, in the United States, it's not all bad. We have some of our regulators have been making concerted efforts to become more innovation friendly, and we have certain certain advantages from a commercial perspective, I mean, the fact that we have such a leadership in the IT and finance areas help us. The problem is, in other respects, our financial regulatory system creates headwinds that we have to struggle against.
I think I'm going to ask Mr. Peters a little bit about the regulatory headwinds that might be out there. You represent a group of companies that are becoming increasingly active in fintech. As you look at the existing landscape, does the current framework we have from a regulatory perspective hinder growth?
I would say that, yes, there are challenges.
Can you identify, I think you're talking a little bit about standardization. Just give us an idea of what the chief regulatory impediment might be in the space of growing fintech.
I think it's twofold. One, we have to consider that technology and financial services, whether the tools are coming from my companies as technology companies or they're coming from financial institutions, technology and financial services are fundamentally integrated. But many of our financial laws were written kind of in a paper or earlier era. And so I think continually we always need to look for opportunities to update, to make our regulatory regime consistent with the modern world that we're operating in. But number two, one of the bigger challenges is just the fractured nature, particularly of state-by-state regulation. There have been some efforts at the state level which are commendable to gain some level of uniformity, but especially with respect to state money transmission licensing, that is a very significant delay to entry in the market, and it holds consumers back from accessing ultimately what they ought to be able to get equally and evenly across the country.
Mr. Smith, some people tend to describe fintech as an adversarial development from the perspective of existing brick-and-mortar banks. When I read your testimony, it's clear that you don't think that's necessarily the case. Can you elaborate on how fintech could actually help traditional banks serve their customers better?
Well, I think that fintech has a special role to play with respect to community banks, insofar as the very biggest banks, the credit card issuing banks, for example, already have access to financial technology, sometimes by going out and purchasing the fintech companies. But smaller banks don't have that same luxury. And so what we find is that fintech is a way for smaller banks to punch above their weight, to serve customers that they wouldn't otherwise serve, to offer products they wouldn't otherwise offer, to diversify risk in a way that they wouldn't otherwise be able to. And one of the things that we're seeing, in my written statement, I cite to an ABA study that says fintech is really do or die for community banks. ABA estimates that there is a $100 billion pool of profits for community banks generally. If community banks are able to capitalize on financial technology to offer new products, they may be able to grow that pie by, the estimate is $15 billion. If they don't, that pie gets smaller by $20 billion. So we're talking about a significant swing in potential profits if banks, or community banks, are unable to capitalize on financial technology to offer new and innovative products to their customers. That's a big deal. And that's something that we don't want to jeopardize by depriving community banks of the ability to access financial technology in that way, by partnering with fintech firms.
Yield back.
Gentleman's time has expired. With that, we go to the gentleman from New York, Mr. Meeks, recognized for 5 minutes.
Thank you, Mr. Chairman. Let me thank all of the gentlemen for your testimony today. I think it's tremendously important what we are discussing. And I would think that from what I've heard, each and every one of you want to make sure that we don't have individuals who are trying to take advantage and or fraud the system, or those that want to harm consumers. And we're trying to figure out a way that we can move forward so that there'll be more opportunities for individuals who may not have access to capital. In the communities that I represent and grew up in, there's not a lot of individuals, whether small businesses or other ones, that don't have access to capital. A lot of banks are not lending to those communities anymore. And I hope that we're not saying that we want, or anyone is saying, didn't hear anyone say that we don't want there to be opportunities within those communities for individuals to have access to financial services. I know from my own lifetime, I've seen in the communities that I represent where people say that there should be nothing there, and we want to protect those folks. When we don't have anything there, loan sharks take over. I want to put the loan sharks and the predatory lenders, and I want to put them out of business, and I think that's what all of y'all want to do. As a result, let me ask Mr. Hoops a question that under current regulation, the line between legitimate third-party lending relationships and abusive charter arrangements is unclear. On one hand, both Democratic and Republican administrations have encouraged third-party lending relationships because of their potential to expand credit access to underserved communities, of which I'm concerned about. And this includes the Cordray CFPB through its non-action letter program. But nevertheless, our banking regulators have also used their current enforcement authorities to stamp out abusive relationships, including past bank relationships with abusive payday lenders. Can you tell this committee, can help this committee distinguish between your members' partnerships and abusive relationships that regulators under both Democratic and Republican administrations have discouraged now and in the past?
Thank you for the question. You're absolutely right. There is great evidence that partnerships between originating banks and marketplace lenders are delivering products to underserved communities, places where bank branches have closed, and delivering products that are more affordable than the products that were available from traditional institutions, and doing so by using advanced techniques that go beyond just looking at a traditional FICO score. And so only financial technology companies that are applying those methods can reach those borrowers. To be clear, the bank partnerships are how those loans are being made nationwide. For almost 15 years now, banks have not been permitted to offer any sort of abusive payday loan or to partner with a payday lender. The Center for Responsible Lending has said in some of its written materials that that prohibition, language from the Office of the Comptroller of the Currency, has been generally effective in preventing payday lending from coming into the banking system or via a partnership. And so I think to answer Professor Leviton's remarks earlier, the legislation Protecting Consumers' Access to Credit Act that you mentioned, that you support and many others do as well, cannot become an avenue for abusive lending because the bank can't make the abusive loans in the first place. Bank regulators simply have not permitted such arrangements in their regulated entities. So I think we do a number of things, and marketplace lenders, again, as I mentioned in my testimony, only issue loans that are in compliance with the FDIC's guidance. Their guidance is that loans must be capped at 36. Again, that makes sense because the bank is the one originating the loan.
Because I'm running out of time, I just want to ask another quick question because I think that we're starting to get the FDIC and the OCC to look and to be regulators as opposed to having anything that's unregulated, which is what my focus is. But also, I sent a letter to the OCC which talked about Community Reinvestment Act, some kind of the response to make sure that people are responding to local communities. And in response to my letter, the OCC required that fintech firms that receive national charters develop business plans that demonstrate their commitment to serving underserved populations. Can you describe how important those requirements are toward establishing confidence among fintech lenders who receive the benefits of national charters for low and moderate income individuals and families?
We'll give you 30 seconds.
Absolutely. So financial inclusion is core to the business model of the companies in the Marketplace Lending Association, and so to the extent that they're interested in pursuing national bank charters, we've gone on record as saying that a financial inclusion requirement, that would be a nationwide requirement, sort of updating the current CRA framework makes a lot of sense. It's, I think, critical that, when given the privilege of a charter, that you also have a responsibility.
Gentleman's time has expired. With that, we recognize the gentleman from North Carolina, Mr. Pittenger. He's right for 5 minutes.
Thank you, Mr. Chairman. Thank you again for each of you for joining us today and offering your expertise to this committee. It's very much valued. I would say that I join with others on this committee who believe that the bedrock of our economy is found in the entrepreneurial spirit, the spirit and the choices that are given in the marketplace. To that end, as one who believes in free markets, I believe that it's important that they remain open and competitive. With that in mind, Mr. Knight, I would ask you to begin with, and others can chime in if they like. What evidence do you see in the existing regulatory environment that hinders future growth of the fintech industry?
Thank you, Representative Pitcher. I think what we're seeing is in particular, the state-by-state nature of regulation for money transmission and lending is causing firms to either not engage, pull back from lending for certain borrowers, have trouble either obtaining the necessary licenses because it can take, it's estimated to take between 1 to 2 years and $1 to $2 million in certain cases from engaging in entering the space. And one of the risks we may find is that the only firms that are coming in now are going to be already large and well-established firms, which is fine. All new competition is great, but we also want a place where brand new startups can actually get in and compete. And so I think that we're seeing that risk.
Anyone else want to comment on that? Very good. I would say this again for all the panel. There's been some talk out there that the fintech industry is unregulated. Is this an accurate representation? Sure.
Absolutely not. The financial technology industry, with the caveat that, of course, fintech is a broad term, but for what we're talking about today, there is regulation. There is regulation at the federal level through the CFPB, through the bank. To the extent there's a bank partnership, the bank regulators get involved. If they are accessing the capital markets, as many of these firms, particularly marketplace lenders, will do, the SEC is involved. For cryptocurrency firms, they are regulated either as money transmitters by FinCEN and the states, or if they are engaged in commodities transactions, the CFTC has jurisdiction. If they're engaged in securities transactions, the SEC has jurisdiction. The FTC has jurisdiction over certain areas. There have been numerous enforcement actions in the financial technology space. So to say that it's unregulated is inaccurate. Now, to say it's regulated exactly the same as banks is not necessarily true either. But then we need to ask what are the relevant risks, and are the relevant regulations the same? So, for example, fintech lenders are subject to Truth in Lending, Equal Credit Opportunity Act, all of the federal consumer protection laws engaged in lending. They're not subject to the same safety and soundness requirements as banks because they don't have federal deposit insurance, they don't take deposits, they don't have access to the discount window, so they're not generating that type of risk. The risk they're generating is a consumer protection risk, and they are subject to the same consumer protection laws.
Very good.
May I add something to that?
Yes, Professor.
I would agree with everything that Mr. Knight says, but fintechs are subject to the same laws, but not to the same supervision mechanism. The CFPB has supervision authority, actually going and doing exams over large banks. It does not over most fintechs.
Thank you. I need to move on. We've got less than a minute. I would like to ask, what can Congress and prudential regulators do to facilitate the adoption of fintech to the U.S. without putting consumers at risk? Mr. Knight, you can proceed on that if you'd like.
Sure. So among the things they could do is, as mentioned previously, create an environment where firms can innovate while maintaining appropriate consumer protection. We can provide certainty to the relationships with banks. We can streamline the licensing requirements, and so the answer might be something like the OCC charter. I think we should also look at ways to allow state-licensed entities to operate on a national basis, sort of like we do with state-chartered banks.
Thank you. Mr. Hoops, I would just ask what can be done to help grow our local communities, particularly rural areas. I have a very rural part of my district.
Absolutely. I think marketplace platforms are available to borrowers wherever the internet is available. And so, I think one of the initiatives that we're supporting is, rural broadband access. We think it's, one of the only way that a borrower is going to find us rather than a, potentially, a worse product at a local storefront or strip mall is if they can access the internet. So, that's a key, I think, initiative for Congress to continue to work on.
Thank you. My time's expired.
Gentleman's time has expired. With that, we recognize the distinguished gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Mr. Chairman. Welcome, panel. FinTech, no question about it, is really dramatically reshaping how Americans are now receiving their financial services and doing an excellent job of that. Nowhere is that more poignant than in their capacity to be able to help work and partner with traditional banks so that they can better serve underserved communities at a reduced cost. You take Cabbage, for example, in my city of Atlanta, doing a remarkable job, using their innovative capacity of the speed of their computers to do wonderful things like helping people if they pay their loan back faster, they get a reduced cost. All of that is going well. But there are critics out there who are saying that there should be more protection, and that protection should be at the state level. But here's the problem. We got 50 states. They vary from state to state. On top of that, you got the OCC moving for a charter for these fintech companies. And you got them all chopping at the bits now to regulate, from the OCC, CFPB, Treasury, the Fed. I mean, this is getting to be very problematic. So let me ask you, Mr. Smith, what do you say about this? And how does this patchwork, this whole situation, could lead to increased costs and do just the opposite?
Well, you're right. Thank you for the question, first of all. And you're right that the patchwork of regulation can lead to stifled innovation, and it has a and one of my biggest concerns is that it can be so prohibitively expensive to build a national platform on a state-by-state basis that it becomes an enormous barrier to entry for a new firm with a bright new technology. So as an example, I'm a lawyer here in Washington, D.C. We advise a lot of companies on these issues, and conservatively, it would take 2 years and a couple of $1 million to license and build a platform on with a state-by-state through the state-by-state licensing system. Now, the other problem is that many states don't even permit you to offer certain types of products. So, offering a credit card, for example, through a state-licensed model, I think would be impossible. But what we have in this country are a variety of different regulatory models, right? So the state-by-state model works for some, and I think that for some, being a bank works. For others, partnering with a bank can work. And I think that we want to make sure that we preserve the benefits of all of those regulatory systems. And I think, by partnering with a bank, it's not a free pass for a fintech firm. You are going to be subject to this pervasive scheme of federal banking oversight, federal banking agency oversight, including direct examinations of the fintech firm itself. And that's quite substantial. And I don't see why we wouldn't, if we have an opportunity to put people in a good bank product, why wouldn't we do that? Why wouldn't we capitalize on that?
Well, thank you, Mr. Smith. Now, Professor Levitan, in your statement, you said this. You said that fintech companies can be risky and fraudulent. And I think that we need to hear you. How so? Because this is an important hearing. And that's the one thing we do not want our fintech companies to be. So could you tell us what you mean by that?
Sure. On the simplest and easiest level, we can just take cryptocurrency companies. We've seen plenty of fraud in the cryptocurrency space, and it seems to be growing, where consumers invest.
You said crypto space?
Cryptocurrency, things like Bitcoin and Ethereum, all kinds of. I'm not quite sure how to describe them other than cryptocurrencies.
Right.
where sometimes people think that
We're
they're
moving very fast.
I'm going to try and move fast. I see that the time's running out. Where people think it's are deceived about the nature of the investment that they're making. But also, I think it's important to note on the lending front, the use of bank partnerships has one purpose only, and that is the evasion of state usury laws. There may be reasons to question about state usury laws, but we should, if we're going to have banks, fintechs operating in that way, there should be a federal standard that they all have to comply
And
with.
Mr. Smith, do you agree with what he said?
No, of course I don't. I think that the purpose of bank partnerships and bank relationships is to expand access to consumer access.
Thank you.
Expand consumer access to innovative products and help banks compete better.
Thank you, Mr. Chairman. I appreciate it.
Slipped an extra one in there, Mr. Scott. That was pretty slick. Gentleman's time has expired. With that, we go to the gentleman from Kentucky, Mr. Barr, chairman of our our Monetary Policy Committee. He's recognized for 5 minutes.
Thank you, Chairman. Appreciate you holding this hearing, very important hearing, and obviously FinTech has tremendous potential and promise to enhance financial inclusion, to help unbanked and underbanked individuals in this country access financial services that they otherwise would not have access to, and the promise for low-cost financing and the speed of payments. This is a really innovative space, and it occurs to a lot of us here as we look at how to improve the regulatory framework. We should first do no harm. Mr. Knight, this concept of a regulatory sandbox is intriguing to me. The fact that it's been tried in other jurisdictions successfully without compromising consumer protection is interesting, so that we can foster innovation in this space. Let me either start with you, Mr. Knight, or Mr. Smith. I want to explore this Madden versus Midland decision a little bit more and understand it a little bit more. Can either one of you, well, let's start with Mr. Knight, since you've written extensively about this decision in the Second Circuit. Can you discuss this valid when made doctrine and why it would be important to codify that decision?
Thank you. So,
or that doctrine, rather, to overturn the decision.
yeah,
Sorry.
please don't codify Madden.
Right.
So the issue is whether or not a loan that was valid when it was made, right? So a legal loan that the law, the borrower, the lender all agreed was okay, can subsequently become usurious and invalid, not because the obligation to the borrower has changed in any way, in any material way, but because the loan is sold to a third party. And so in Madden, what happened is it was a credit card that defaulted, and the credit card debt was ultimately sold to a debt buyer who sought to collect on it. And while the loan was valid when held by the bank under federal law, the Second Circuit found that the loan had subsequently become invalid, not because the loan's terms had changed, but because the ownership of the loan had changed. And the obvious problem there is if you have a situation where a bank wants to sell a loan, be it to a fintech firm or a debt buyer or potentially in the securitization market, and the buyer is not a bank in a state where that loan would have been valid based upon the bank's home state usury law, it calls into question the validity of the loan, which cuts off, or risks cutting off funding because people are not going to fund loans that they think are going to turn out to be invalid.
And so, in the impact, can you speak to the impact and the holding of Madden in terms of credit markets? And has there been any identifiable impact on access to credit for either consumers or small businesses as a result of that decision?
Yes, three professors in an article that is forthcoming from the University of Chicago Journal of Law and Economics studied the impact of Madden in New York and Connecticut versus the rest of the country, and found that for marketplace lenders, they were seeing less funding for loans from borrowers with relatively low credit scores compared to the rest of the country.
Okay. So let's go to the lawyers real quick. Mr. Smith, obviously, Professor Levitin and other critics have expressed concerns that these loans made by banks through their fintech partners are really just an attempt to provide a backdoor rent-a-bank model for payday lenders. But isn't it true that the loans that would be regulated that these loans would be regulated just like all other loans made by that bank, including the oversight by all the federal regulators, the FDIC, the OCC, the Federal Reserve, not to mention the CFPB.
Right, to the extent the CFPB would have jurisdiction over the bank, right? CFPB doesn't examine banks with less than $10 billion in assets.
Sure, but the
yes,
point is, those banks are regulated, and that loan, valid when made loan, is regulated.
That's absolutely right. And the FDIC has been a bulldog on this idea that doesn't matter if the bank originates the loan in partnership with a fintech firm, all of that activity that happens to originate and service the loan, that's as though it's happening inside the bank, and it's going to be examined in the same way.
So when we talk about financial inclusion and access to affordable financial services, rural area, I represent a rural area in Kentucky. How important is it to community banks, credit unions, particularly in rural or underserved areas, to have access to these relationships with these fintech companies to serve their customers?
Well, for the community banks, you know, originating loans, servicing loans, that's complicated, and it's particularly complicated when you're doing it over a mobile device or over the internet. And these community banks, they don't have that know-how. And the credit unions, the same way. Credit unions operate frequently through organizations called CUSOs, credit union service organizations. But they outsource everything. They outsource all of the marketing, all of the origination, all of the servicing, and they need to have access to these services in order to continue to offer these products to their customers.
My time's expired.
Gentleman's time has expired. Will that go to the gentleman from Missouri? Mr. Cleaver is recognized for 5 minutes.
Thank you, Mr. Chairman, and to the ranking member, Clay. I'm not a member of this subcommittee, but the chair was kind enough to let me participate since our side is almost finished. So I'll try to be economical with the time I've been given. This issue, as I don't have to tell any of you, affects many Americans, even without them knowing it. And it has the potential to either dramatically expand the playing field for funding new ideas from all corners of the country if it is done correctly. And I think that we also have to deal with problems that may emerge. That's why I hope this hearing today will be just the first, Mr. Chairman, that Congress convenes on this tectonic but consequential issue, and it will ultimately end with some kind of common sense legislation. It may be of some value for us to know that South Korea has already issued rules on cryptocurrency. My concern is that we're going to, if we are not clever and smart, we're going to end up seeing a lot of the countries with whom we do business actually moving further than we have in this arena. And so this is serious stuff, and I am also concerned that while I have some concerns about fintech, I do believe that the financial technology is a force of good in this country and not a foreboding force for expanding and exacerbating racial and income inequality in the United States. We can't hold back the waves of progress. They're coming. We need to be ready to deal with them as quickly as we can. I'd like to ask a question. Professor Levington, at the end of your testimony, you discussed the importance of the Consumer Bureau moving forward to implement Section 1071 of Dodd-Frank and collecting small business lending information. Would you please discuss why this is important and how having less data in the small business lending space makes it infinitely more difficult for policymakers to assess what adjustments may be needed?
Well, I would hope that everyone in this room would support evidence-based regulation, that we want to be regulating based on facts, not based on just the way we think the world ought to work. And we can't do that unless we have data. And unfortunately, there's not very good data that's currently available about small business lending. Marketplace lending, a lot of it is either formally small business lending or functionally small business lending. A contractor who operates just as a sole proprietor who might borrow money to purchase a pickup truck that he's going to use to drive his kids to work, but also that he's going to use for business. Is that small business lending? I think arguably so. Any which way, we want to know if we want to do good regulatory policy, we need to know what's going on in small business lending. And particularly, we want to know if there is discrimination in small business lending. Are small business people of color, or women-owned small businesses, are they getting credit on the same terms and with the same ease as other small businesses? We have no way of knowing without the Section 1071 data collection. It's a shame the CFPB hasn't started that collection already, and I would urge the current leadership of the CFPB to take action on it.
Yeah, my concern is not that there is this wolf-like intentionality to, discriminate against certain groups, but that, when we're dealing with the algorithms, we are putting down opinions and ideas from human beings that play out. I appreciate the time, Mr. Chairman, and thank you all for being here.
Gentleman yields back his time. With that, we go to the distinguished gentleman from California, Mr. Ross, the Chairman of the Foreign Affairs Committee, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Hoops, technology, of course, can improve the quality of underwriting and obviously then lead to more accessible loans, more affordable loans. So I introduced this bill. It's a bipartisan measure, the Credit Score Competition Act. And what that does is to mandate that the GSEs modernize their acceptance of new credit score modeling in order to sort of evolve into a circumstance where the products that can offer information like telephone bills, utility bills, and those are the obvious ones, but the industry understands there are many, many other risk correlators out there that really would help those underserved consumers who have very thin or non-traditional credit histories. So that's the concept. So could you discuss the benefits of technology to the underwriting process as it applies to that goal, and what obstacles might exist for fintech applications to build on these platforms, and maybe reference the concept behind the legislation?
Absolutely. So what my members have found is that FICO is not particularly predictive. They've moved beyond FICO in their modeling. Obviously, traditional metrics are still used, but additional data points have proven to help my members move borrowers who, if analyzed by a traditional player, would have considered them subprime, and move them into more of a prime bucket in terms of the pricing that they're getting on credit. The only way they're able to do that is by assessing a variety of data points and finding ones that suggest that the person will be responsible, more responsible even than their thin credit file would originally suggest. So the purposes of the legislation, I think, are absolutely right on for what our members have experienced in the financial market.
Thank you. My second question, my last question, I'm a very strong believer, as we've had these debates in the past here in the committee, that effective regulation of interstate commerce should be done on a very uniform basis. And this doesn't necessarily mean a national regulator. It could mean, at the very least, though, standards set by one body. And by the way, I don't believe this only applies to financial technology marketplace issues. I think it should apply, it's a basic economic principle. So in the past, jurisdiction by jurisdiction regulation has led to a situation where we've got political pull and over-politicized and balkanized laws very clearly, that lead to inefficient markets. Obviously, it leads to barriers of entry, or at least manipulation in order to prevent entry into a market. And you see incumbent interests trying to block fresh faces from coming into these markets. You can see how they do it. So how do we avoid this outcome in the fintech space? And I guess a national charter might be one concept. You could look at the industrial loan company charter as a model, or other models along that line. But I'd just like to ask the panel for their thoughts very quickly on this.
So I agree 100% with you and your misgivings about state-by-state regulation. On the other hand, I think that what we have in this country is a multiplicity of regulatory models, and some models work for some players, other models work for other players. So state-by-state licensing always has a place. Becoming a bank always has a place. Getting an industrial loan company charter always has a place. And partnering with a bank we should make sure that we ensure that fintech firms are able to partner with banks, banks are able to partner with fintech firms, and not have courts come in after the fact and unravel those transactions and decide that they're in fact someone else, not the bank, was the true lender.
Other commentary?
I would just say quickly for financial innovation now, what we appreciate is the idea of optionality, that there be many options available. So when we recommend that there be a federal money transmission license, that it's optional, so that those who choose to go through the states can still do that if they want. It's that kind of optionality in the system that would be beneficial to, as Mr. Smith said, the specific business model depending on how it's arranged.
I'll just jump in also. I couldn't agree more. I think, just to put a finer point on how unprecedented the Madden decision was, the idea is not that the banks can't make the loans. It's simply that they can only sell loans that were made in certain states to certain borrowers. I mean, you talk about balkanization, you simply can't operate that way.
Thanks, Chairman.
Gentleman's time has expired. With that, we'll go to the gentleman from Texas, Mr. Green, recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for appearing. I'm interested in knowing more about steps that have been taken, Mr. Hoops, by your association to benefit consumers and self-regulate. Can you please give some indication as to what you're doing, please?
Absolutely. I think the core on the small business side is the Small Business Borrower Bill of Rights, and that's an effort, again, that I mentioned earlier, is a joint effort with for-profit entities in the association and also nonprofit entities like Axion and the Aspen Institute, to really look at, from the perspective of the small business borrower. It's a little bit of the golden rule. If you're a small business and you've got a million things to worry about, being duped by a financial institution probably isn't one of them. So that effort is kind of part of our criteria for membership. So you have to adhere to those standards, or you have to find an equivalent standard. So that's around things like disclosure of APR. Again, APR is a way to compare products across terms, right? Do I want to take out a series of 2-month loans at maybe higher APR, or do I want to take out a single loan, might be larger dollar size, at a lower APR that's longer term? And so being able to compare products is a key, I think, part of choice. And candidly, in the small business area, a lot of the consumer protections, we heard earlier how in small business lending and consumer lending start to merge in very, very small entities. And so, that effort, that self-regulatory effort, while it hasn't been adopted by the entire industry, is an effort to say that those small business borrowers are people too, and so they deserve the kind of protections that come with disclosing upfront APR, disclosing if there are any prepayment penalties or fees, making sure that people know what they're getting themselves into, and really right-sizing the financing so that you are only being able to be a profitable lender when your borrower is set up for success as opposed to set up for failure.
And do you believe these to be beneficial to the consumer as well as to the members of your association?
Well, absolutely. I think that educating.
I believe you. If I may, let me just follow up quickly because I have another question. If this is the case, how would you have all of the businesses adhere to what you believe to be reasonable policies?
Sure. So we don't think that our initiative is the only way that you can skin the cat. There are other ways potentially to offer robust disclosure that inform borrowers what they're getting themselves into. I think greater education, this type of hearing is a way that people can be made aware of the differences between players that are online or acting through storefronts.
Allow me to intercede and ask another question. Do you think Congress has a role to play in regulation?
It does.
Okay. Let's move to Mr. Levitin. Let's talk about the risk associated with the cryptocurrencies. And that's not a term that I find favor with. I'm not sure that we're dealing with a currency, but for our purposes and for this hearing, what are some of the risks that we have to concern ourselves with?
I think the largest one is simply fraud, that consumers are going to be duped into investing in cryptocurrencies that they may not understand, or that even if they understand, that there's just simple theft within by a cryptocurrency player. Beyond that, though, even when there's not fraud or not theft, there's simply just a tremendous investment risk in cryptocurrencies. I think what we've seen with Bitcoin prices over the last year is kind of a classic example of just extreme volatility in an investment. It's not a particularly suitable investment for most consumers, and I worry that you have consumers who don't really understand the risks, even when there is an outright fraud, but they don't understand the risks they're taking by investing in cryptocurrencies. And I would also add one other thing, which is a major use of cryptocurrency is money laundering. And beyond speculative value, that's really the major purpose for the use of cryptocurrencies. And that's not something that we should want to encourage.
I completely agree, and my time is up, so I'll yield back, Mr. Chairman.
Gentleman, time has expired. With that, we'll go to another gentleman from Texas. Mr. Williams is recognized for 5 minutes.
Thank you, Mr. Chairman, and for holding this hearing in the financial technology industry, which has shown tremendous growth since 2010, is becoming increasingly important to individual consumers and small businesses alike. Now, this segment represents the new opportunities in the communities I represent, and I'm interested to find out more about the future of this industry segment and the role Congress plays. We're doing a good job of that today, and I want to thank all the witnesses for being here in your expert testimony. My first question to you, Mr. Smith. I'd like to take a few minutes to discuss the impact that fintech has had on community banks. As a member of this committee, I continue to fight for community banks and small institutions that are the backbone of Main Street, which I represent. In your testimony, you discussed that banks often choose to partner with already existing fintech companies rather than enter these markets on their own because they would incur great expense. So what factors can you identify that contribute to that great expense? Does it have more to do with technology and not knowing the market, or other costs that push banks toward partnerships with fintech companies?
Well, so the first issue is the technology that you've mentioned. In offering these products through an electronic platform is a complicated thing to do. So what we're talking about here is marketing, originating, servicing a credit product electronically. That's something that a community bank wouldn't necessarily have the expertise to do on its own without help from an outside fintech firm or without spending millions of dollars and years to develop its own technology. Now, of course, the biggest banks can do that, right? But it's the small banks that need to rely on others to help them offer these products. The other issue is liquidity, and smaller banks need capital, need people to whom they can sell these loans, whether it's participations in the loans or the whole loans, in order to get back to the business of lending. That they need to, they can't be overexposed to any particular set of credit risks, and they need to be able to sell these loans so that they can deploy their capital back in the lending business. And I want to caution, though, that there's a lot of talk about how, banks are no longer at risk, and that's not right. When a bank originates a loan, the bank is always on the hook as the original lender for truth in lending, for unfair deceptive practices, for fair lending. In addition, banks frequently have credit risk, either because they retain a participation, because they have repurchase risk, or because they have what's called pipeline risk, where they're concerned that their counterparty may not have, and this is outlined, in fact, in Professor Leviton's testimony, that the counterparty that stands ready to purchase these loans may not be able to make good on its obligations. So there's risk there, too. So it's not a free pass for banks. It's not a free pass for fintech firms, but it works for consumers.
Okay. Next question also, Mr. Smith. One section of your testimony that stands out to me is a study you highlighted by the American Bankers Association, which says by 2020, community banks could lose as much as $15 billion to fintech firms and other banks going digital. But on the flip side, if they adopt fintech, we've talked about this, they could gain as much as $20 billion in revenue by 2020. So those numbers are pretty dynamic. What kinds of new business is created when community banks go into the fintech space, and what kinds of customers can they serve that they would not otherwise?
So my focus in the testimony has been on credit partnerships and lending partnerships, but I think that any kind of financial product, whether it be a prepaid card or a peer-to-peer payment service, all of these bank products, deposit taking over the internet, all of these bank products can be offered through the use of financial technology, and community banks, there's no reason why community banks can't do that too, as long as they have the know-how.
Okay, another one for you. You identified the good that community bank partnerships with fintech can bring, but in your testimony you also mentioned that there are problems. One of the most prominent obstacles, your point was, that you pointed out in your testimony, was the uncertainty over inconsistent true lender decisions. I agree with you that without certainty, market participants might not be willing to enter the market. So this can have the ripple effect of hurting consumers and banks alike. So real quick, to what extent would the Modernizing Credit Opportunities Act proposed by my colleague from Indiana, Mr. Hollingsworth, how would that solve this problem?
Well, so in theory, there is no problem. I think that the law is crystal clear on this subject, that if a bank makes a loan, then the bank is the lender. But apparently some courts are being led astray. And when I say some, I mean a very few. We have several cases that address this issue. In many of those cases, the court has said, yep, I'm looking at the loan, the bank is the lender, that's the end of the story. A couple of other courts, though, have said, no, let's look beyond this transaction. Let's figure out who has the quote-unquote predominant economic interest in the transaction. And that's the rub. That's where the uncertainty comes in. And so we need to make sure that, and I think Mr. Hollingsworth's bill would do this effectively, to basically reinforce what we all know that the law already requires.
Thank you for your testimony.
Mr. Williams' time has expired. With that, we go to the gentleman from Washington. Mr. Hecht is recognized for 5 minutes.
Thank you, Mr. Chairman, very much. I'd like to begin by asking each of you to answer very briefly how you define the fintech space. It just seems to me that this is incredibly amorphous, and in order for us to begin to make progress on advancing our thinking about how we may or may not need to update regulations, we ought to have a sense of what this is. So starting with you, Mr. Hoops, and going down the line, and briefly, please, I have a couple other questions. How do you define the fintech space?
I guess I'll focus on lending, since it's what we do. In lending, I think the fintech space is firms that are offering credit and using processes, all via the internet, technology-enabled machine learning to really transform the experience for the borrower, and then on the flip side also create opportunity for investors. Again, all done in a way that is remarkably different, faster, more efficient, more transparent than previous examples.
Speaking of being faster, quicker, more efficient, because I really want to hear briefly from each of you. Thank you, sir.
Most broadly, the application of technology to the provision of financial services. For these purposes, the provision of financial services by non-banks via non-traditional underwriting or delivery mechanisms.
Mr. Peters?
Well, I actually agree with you and don't use the term fintech as often as I can. I try to avoid it. For us, it's using technology to make people's lives simpler and safer.
Mr. Smith?
So I have a prop here. To me, it is offering financial products and services to consumers and small business over this.
Over a mobile device.
That's it.
Professor?
And everything that goes along with it.
I'm going to try and do this.
I'm going to try and do this in 280 characters or less. Non-bank financial services companies without a brick-and-mortar presence.
So it seems to me that there are a lot of different businesses that are kind of in this space. You've got mobile payment, mobile banking, which really rest right on top of banking. You've got marketplace lenders who are literally in direct competition. Theoretically, you also have cryptocurrencies, which could serve, if they were completely robust, and I'm not suggesting they ever will be, to replace banks. Do I have that about right, Mr. Peters?
My companies look at blockchain and the technology, and we find it very interesting, but we take no position on it.
The question wasn't whether you have a dog in this fight. The question was whether or not, if they were ever fully developed, they would in fact be replacing banks.
We just don't have a position or opinion on it.
I didn't ask you if you're for or against it, Brian.
For us, the underlying technology is very, very interesting and very compelling. I think we're watching it develop.
All right. So for anybody that wants to answer this question, I've been paying a lot of attention to the push to finally get to the point where we make faster payments. I think an area of financial transaction where we lag the rest of the world, frankly. I was interested recently to learn that the Fed actually levies a fee for anything that's posted after 5 p.m. And I wondered if that was an example of an impediment to getting to faster payments. But more broadly, I'd be interested if any of you have, very quickly, as time is winding down, examples of other regulations that might keep us at the Fed level or anywhere else from getting to a faster payment scheme, much like the rest of the world. Professor, let's start with you and go down the line in 50 seconds.
Well, I'm not sure I have an answer that's directly on point to your question.
Okay, Mr. Smith?
Same.
Mr. Peters?
I don't think there's a regulation that needs to be removed. I think the Fed is shepherding a very commendable process to get industry to an industry-led solution here. They're shooting for 2020. There will be a variety of solutions that come to market, and hopefully we have interoperability and ubiquity of faster payments by that date. That's something we care very much about. It matters.
You want to see it happen?
We do, absolutely.
Mr. Knight?
So the product of regulation, one of the challenges we face is the number of FIs we have in this country relative to other countries. If you look at the countries that have done faster payments, they have few large FIs rather than many relatively small FIs like you see here.
Mr. Hoops, the time I do not have remaining.
The IRS Data Verification Modernization Act would enable much faster disbursement of loans. You would be able to, as a lender, verify somebody's income when they've already agreed to share that information.
Thank you, Mr. Chairman. I am yielding, evidently.
The gentleman yields back. This time the chair recognizes himself for 5 minutes for questioning. I find ourselves in an interesting position, but not a position we haven't been in before in America. Recently, I read an old newspaper article from the early 1900s from a very prominent national newspaper that said, humans will never fly and shouldn't. And this was at the time when two bicycle mechanics from Ohio were attempting to fly, Orville and Wilbur Wright. I see where we are in the fintech industry, especially from someone who spent 20 years in the IT business, in an interesting position because this is a consumer-driven solution to a demand by consumers to apply technology we have available, as was said earlier, to make their lives better, simpler, and provide something that, because of various reasons, much being government regulation, that traditional financial institutions couldn't provide them in many cases. And we often find ourselves where traditional bureaucrats or government regulators find themselves in a position where they're trying to put a round peg in a square hole. And this new industry, this new technology, which is demanded by consumers and many of the younger generation, is we find ourselves in government telling them, no, you can't have what you want because it doesn't fit the traditional model or ideas that we have. And so we find ourselves uniquely in this position again of how do we bring these ideas and these technologies to fruition, which the market has brought themselves, but ensure that the consumers are protected. And so I think it requires government to catching up with the time, which is very difficult to do sometimes. Mr. Hopes, some, including Professor Levitin, have stated that bank-fintech partnerships raise concerns about safety and soundness and consumer protections. Is this accurate? And can you explain a little more about the relationship between banks and fintech?
Sure, it's absolutely not accurate. I think if anything, a bank partnership brings additional regulation and supervision onto a fintech. That's pretty clear. The FDIC, in the case of state chartered banks, or the OCC, has the ability to directly supervise third parties.
Okay, thank you very much. And I do appreciate the illustration somebody used by this device, because our world revolves around this device, and this device is really an empowerment of the individual. I mean, you can do everything from booking a flight and a hotel and planning your whole vacation right here on this device, and it has become the lifeline for many people in America today. I've often thought if you applied the regulations that we've applied to things from healthcare to everything else to this, you would actually have a revolt by many Americans because of the restrictions it would add. But another concern I have in the remaining time is as we migrate to more technology, security becomes a greater issue because we do tend to consolidate a lot of information, which I think is one of the advantages of blockchain technology in whatever area we're going to utilize that. Mr. Peters, I know that in your comments you addressed some security concerns, and as you know, the expansion of EMV chip technology on payment cards has increased by acceptance by merchants and has resulted in significant decline of point-and-sale fraud. However, on the online marketplace, this has been increasing. What can we do to help in the online sector?
It's a good question. Obviously, as I mentioned, we are security companies first, and large organizations come to our companies, Northrop Grumman, the CIA. They believe that we know what we're doing when it comes to security. And as you pointed out, on that device that we all have in our pockets or on our wrist or maybe elsewhere through a voice assistant, we are adding layers and layers of security to that, whether it's encryption, whether it's biometric authentication. In the applications themselves, there are a whole host of security measures in place. So we believe that in the online environment, there's actually many more opportunities, many of which we've been developing now for years, to ensure that you do have actually a higher level of security and authentication than you may have in the brick-and-mortar environment. From a kind of a policy perspective, I would say that our system right now is in terms of the kind of the pricing around security and fraud reduction is somewhat arbitrary. It would be worthwhile for the committee to explore a way to align the incentives of security for merchants and for banks and card networks around that rather than an arbitrary level.
Okay. Thank you very much, and my time has expired. The chair now recognizes a gentlelady from New York, Ms. Maloney.
Thank you so much, and I thank you and the ranking member for calling this hearing and all of the participants. First, I'd like to ask Professor Levitin, one of the cautionary tales about fintech that you cited in your testimony was the Bitcoin exchange called Mt. Gox. Back in 2014, Mt. Gox was the largest Bitcoin exchange in the world. But then someone hacked the exchange and stole 450 million, as in million, worth of Bitcoins. They disappeared in thin air, and the exchange collapsed overnight, and many people lost their hard-earned earnings. I'm extremely concerned about virtual currencies like Bitcoin because a great number of average investors are pouring their life savings into virtual currencies, and they stand to lose a great deal of money when this bubble eventually bursts, as nothing is backing it up now. People are treating these things as investments when they are just currencies. And that, in my opinion, is a big problem, because there are absolutely no protections for these investors like we have in stocks and bonds. So I'm working on a bill that would treat virtual currencies that are being used as investments as securities, so that investors will get basic investor protections like adequate disclosures and rules against market manipulation and market fraud. But another big problem in this space, which you highlighted with the example in your testimony of Mt. Gox, is that the virtual currency exchanges are constantly being hacked. Just last weekend, another virtual currency exchange in Japan was hacked, and they lost over $550 million worth of virtual currency, the largest cyber heist in history. So my bill would also subject virtual currency exchanges to exchange-like regulation by the SEC, including robust cybersecurity standards to ensure that these massive cyber heists stop happening. Now, in no way do I want to interfere with the innovative technology that is coming into being through these currencies, but this doesn't hamper that, which has great promise, I think, for the future. So my question, Professor Levitin, is do you think that we should just let virtual currencies continue to be the Wild West with no protections whatsoever? Or do you think we need to start taking some precautions on virtual currencies so that people don't lose their entire savings in these markets, which has been happening? And then I invite others to give us your comments and beliefs and on what is happening.
Mrs. Maloney, I believe you're exactly right that there needs to be some sort of regulatory framework for virtual currencies or cryptocurrencies. I think there's a fine line, though, between creating such a regulatory system and putting a stamp of legitimacy on virtual currencies as investments, and I think one would want to be careful about that. Of course, if they are regulated in a safe and prudent fashion, then I think the concerns about legitimizing virtual currencies as an investment are reduced. I think it's important to note that any kind of, let's say, securities law-based regulatory regime, it doesn't in any way reduce the potential benefits from the underlying blockchain technology. This is, any kind of securities-based regime would be about the use of virtual currencies as investments, and the underlying technology, which can be used for a lot of other things, would not be affected by it. Unfortunately, there is not any kind of good solution for the hacking problem. We can have legislation directing, optimal security standards, but the nature of hacking is it's not always preventable. It's just how well can a company fortify itself so that it is a less inviting target than some other company. And I think this is going to be a problem that's going to bedevil financial regulation, not just of virtual currencies, but also banks are also common targets for hacking. I think this is going to be a problem going forward for quite a while.
Would anyone else on the panel like to respond? No? Okay, my time is up. Thank you.
The chair now recognizes the gentleman from Indiana, Mr. Hollingsworth, for 5 minutes.
Well, good afternoon. I appreciate everybody being here. I have to tell you, so I've listened to much of the testimony and am still yet really excited about the opportunities that could be afforded by the expansion of fintech, frankly. The opportunity for more and more individuals across this country to get access to credit to use to build a better future for themselves, for their families, and for their communities. And frankly, this is exactly what we've seen technology do in a variety of spaces, right? Enable and empower companies to reach consumers that they wouldn't otherwise be able to reach because we're lowering the transaction costs, right? Instead of having to build a huge branch in a local small town community like I have all the way across my district, we're enabling these products, these offerings to be made over the rails of existing technology. We're finding people who may, by traditional standards, have challenging credit scores or challenging situations, but through new algorithms, new technology, new capabilities are saying they might be great credit risks for these type of products. And so I'm excited about that, and obviously in participating in the development of that through my Modernizing Credit Opportunities Act, which I recently introduced as a bipartisan piece of legislation to help ensure that this opportunity remains robust for technology companies to be involved in. And Mr. Smith, what I wanted to ask you was, a lot of things have been said about this particular piece of legislation, but the reality is we're not breaking any wild new frontier ground here with regard to this legislation, but rather reinforcing what has been an existing precedent and principle for many, many years, and ensuring that that same principle applies to this operation just because it's technology. Is that right?
That's right. That the law is very clear. Where the bank makes the loan, where the borrower agrees to repay the bank is the lender.
Right.
And that's the end of the story. And you shouldn't be guessing at the motives or intentions of all of the different participants to this transaction. And if what we're talking about is making a loan to a consumer over this device, there are a lot of different people who play a role in that, and there's a lot of different expertise that plays a role in that. And the bank has to hire out for that expertise. And banks have always done this. Banks have tens of thousands of, big banks have tens of thousands of service providers. Nothing different than what we're talking about here. Bank asking others to help it provide innovative products to consumers and to small businesses.
Absolutely. So again, this is the same product, in effect, sometimes different offerings, but the same basic product that's being offered by banks all the way around the world, right? And that has always been offered by lending institutions. It's run over new and innovative rails, in effect, that lower those transaction costs and enable them to reach deeper into communities, whether that's small rural communities like I've got in district, or whether it's in more urban, densely populated areas that might not otherwise be able to reach those communities. But ultimately, it's the same basic product, same basic principles applying, and the legal precedents that have been in existence and allowed the secondary market to flourish, we're just saying those same principles need to apply here. Is that right?
That's right. And I would say, though, that this financial technology enables banks, particularly community banks, smaller banks, that wouldn't otherwise have access to this technology, frequently to offer new products. So to offer an open-end product rather than a simple personal loan, or to offer an auto loan, or to reach, as you say, different communities, different people through different channels.
Yes.
So those aspects of it are new, but the bottom line is it's credit. And here's the other bottom line. If it's being offered by a bank, it's being supervised by a federal banking regulator.
Right, right. And I think you bring up a great point, because not only will this enable more people, right, to be able to have access to credit than otherwise wouldn't be able to, but also open up the number of products that they might have access to, right? Because no single product fits everybody, right? I've got different needs in Jeffersonville, where I'm from, than an hour and a half north in the suburbs of Indianapolis and Greenwood. Those needs are very different. And we used to have community institutions that serve those particular needs, and we become more and more challenged because of some of the regulatory framework to have those individual community institutions serving those communities, serving those individuals with unique and different products. And I think this is really going to open that up. And with the small amount of time that I do have left, I would like to enter these letters of support into the record. This one from the Innovative Lending Platform Association, this one from Consumer Research, a free market consumer group, this one from the Electronic Transactions Association, and this one from TechNet.
Without objection.
Thank you. And with that, I'll yield back, Mr. Chairman.
Gentleman yields. The chair now recognizes a gentleman from Minnesota, the slapshot king of Alaska, Mr. Emmer, for 5 minutes.
Well, I think thank you is in order, Mr. Chair. Thank you for letting me participate today. Thank you for the esteemed panel that we have on what I consider an amazing topic, despite the way I look, my youthful looks. You know, I know all about this cryptocurrency stuff. But it's been an area that I've been very interested in since I got here. And to the panel, as you may have seen, the chairman of the SEC and the CFTC recently co-authored an op-ed in the Wall Street Journal where the concept of a more direct regulatory approach towards financial technology was discussed. They said that, quote, cryptocurrencies lack a fundamental characteristic of traditional currencies, close quote, and, quote, other hallmarks such as governance standards, accountability and oversight, and regular and reliable reporting of trading and related financial data, period, close quote. That's what makes it go. And you're here because I also read in their article that the problem is typical currencies have the backing of a sovereign. I mean, people are in this space. They started in this space because they were looking to get away from that. There's an argument about the way different governments handle their currency, and they wanted more freedom. The question, I'll start with Mr. Peters. In many ways, it seems like the potential for blockchain technology, virtual currency, and other fintech advances runs parallel to the early days of the internet, which benefited from a light touch or hands-off approach to regulation. Do you agree with this statement?
I agree that there are many similarities to the early days of the internet in the way you understand the underlying technology. With respect to policy, my organization does not have a particular position on it.
Well, let me ask this. I'll follow up with you. What are your thoughts on additional regulation in this space? I mean, we've kind of talked about it generally. Everybody assumes, well, you know, we have banks, we have this, we have that, so this should be regulated. But I fear that the second you start doing this, you are going to suffocate what is a incredibly fertile ground. And to the people who say tremendous risks, there's tremendous risk when investing in new technologies, to Professor Levitin, there's always risk. That's what, with the greatest risk comes the greatest reward, and there's this thing called buyer beware. So I just ask, if that's what we're talking about, where is that regulatory balance? And should there be?
For us, we're focused on the digital wallets that we already have in the marketplace. And you know, in many ways, the challenge from a regulatory perspective is one of scope and operational efficiency in terms of how you bring a service to market. You know, again, without any sort of specific position on blockchain or cryptocurrency, you know, our existing wallets based on U.S. currency are focused on that regulatory impediment.
But that's the problem.
Well,
that's the problem. And now we're going to try and make cryptocurrency follow along as though it's U.S. currency. Mr. Knight, maybe you can answer the same question.
Sure. So I think we need to keep in mind that I think the early internet is a good parallel. And the early internet was regulated with a light touch. There were, however, still regulations for things like fraud. If I defrauded you over the internet, I still went to jail because you need certain regulations to enable a market. Otherwise, people won't come. One thing I do think we need to be looking at in this space, particularly with regards to things like the securities laws, is are there areas where the technology allows us to address a risk that we are currently looking to regulation to address? And then, if so, roll back that regulation so that duplicative regulation is no longer necessary. That's not to say that there aren't significant challenges that we're seeing right now, and I think the SEC has shown admirable restraint in the ICO space, but at a certain point, if you're committing securities fraud, you have to be held accountable or else the securities market seize up. So I think that the CFTC and the SEC have done a reasonably good job of trying to target legitimate bad actors and take them out, as they should, while working with just the hapless and ignorant and helping them get back into compliance and unwind their offerings.
Well, one thing I want to point out before my time runs out, and I guess in a way ask Mr. Hoops, I think it is, you were talking about how your members can actually, the algorithms, the way that they can qualify people for different loans, and the discrimination piece is gone. Is it fair to say that your members can actually get more information and more reliable information using algorithms on information that's already available on the internet?
That's correct.
So isn't that going to solve a whole bunch of problems going forward? And don't we have to worry about over-regulating in this space?
I mean, I do worry about over-regulation. You also have to realize financial services is a very regulated framework. And so all of our members, work really hard to ensure that as they do new things, they remain in compliance with all existing law.
Well, I appreciate it, Mr. Chairman. Thank you for your patience. And thank you for letting me go here right at the end. I could continue this for a long time, but we'll be done for today. Thank you.
Gentlemen's time has expired. I'd like to thank our witnesses for their testimony today. This is an important area. I think we'll be hearing more and more about it. Hopefully, we'll be more engaged in this. Without objection, all members will have 5 legislative days in which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days in which to submit extraneous materials to the chair for inclusion in the record. With that, this hearing is adjourned.